I think what you've seen here recently is going to continue for the short term, which is continued U.S. dollar strength. This is the old story that we've all been taught since grade school, which is don't fight the Fed. So while the Fed is raising interest rates, you're going to see emerging economies under pressure. Now, those that are pegged to the dollar or closely related to the dollar, such as, say, Hong Kong dollar, Singapore dollar, they will hold up modestly better, at least from a currency perspective, over the short term. What you need is a real capitulation of the U.S. dollar before you start to see real strength. But unfortunately, that capitulation is going to align with the global recession. So we are not necessarily buyers of emerging market equities or emerging market debt at this point, given that the U.S. dollar strength is likely to continue in the short term. But we are monitoring very closely. The one area of opportunity you highlighted a couple of minutes ago, which is the Hong Kong banks. The reopening story in Hong Kong and later on in China will create some real opportunities for us. But right now, we're looking at Hong Kong banks closely.
Yeah, good to know that there's some opportunity out there. And of course, the big story, as I mentioned earlier on in the show, is Japan and what they've been doing. As expected, they held those rates, but stepping in and intervening in the currency for the first time in decades. The yen, as I said, did back off from that 145 level. But will this be able to actually stem the yen's prolonged slide as dollar remains king, as you've been suggesting?
No, unfortunately, this is like David trying to take down Goliath with nothing but a slingshot. So it's very difficult for the Japanese central bank to go out to make long-lasting permanent changes or adjustments to the FX decline that you've seen in Japanese yen. What I think this is really doing is helping to signal to small and medium enterprises inside of Japan that the central bank is willing to support them in the short term. So where they've hedged out some of their FX exposure around the yen dollar, you're starting to get to the upper limits of where that hedging is. So they're giving a little bit of relief in the short term for those small to medium enterprises, especially before a holiday when trading liquidity starts to get thin. It allows them to reposition their hedging for longer term periods. And it actually signals that Japanese central bank is expecting the yen to further weaken, which we expect as well.